If you've traded financial markets before, it's very likely that you've come across the gold market. It's one of, if not the most popular market to trade, and it's been on a tremendous run over the past few years. Because it's so popular, it naturally has higher volatility, which means a lot of price action on the charts. However, I've been teaching traders for many years, and when they come to me trading gold, they cannot deal with the volatility that occurs on the charts. That's why I've decided to do a video today to break down the best way to trade gold using fair value gaps. So let's get straight into it. First of all, I want to explain just quickly what fair value gaps are. You may have come across them before. It's a very popular smart money concept. Essentially, it is exactly what it says. It's actually where you can see a gap in the market from the close of one candle to the open of another. This typically happens overnight, so the market will close for an hour overnight or over the weekend when it's closed. And when that close from the day before comes to the open of the next day, sometimes you can get a gap in the price. Alternatively, you can get these essentially where the price has moved so aggressively in one direction, maybe because of a big news event, that it's caused a gap in the market. Either of those. Really, I don't really care why it occurs. I just know that they're there, and as traders, we can spot them and we can use them to benefit in our trading. So when you think about what I've just said about fair value gaps and the fact that gold is the most popular market to trade, it has a lot of action on the charts. It's typically one of the most volatile, if not the most volatile markets. We get a lot of opportunities because there's a lot of fair value gaps. So in today's video, I'm just going to start on the gold chart from the current price that we're at the day I'm recording this video. And you can do this same exercise with me. Start on the current price and move left. When you're moving left, what you're looking for is any time where there's been a gap in the market. So if I scroll across here and zoom in, you can see there's a gap, and just start marking those gaps. Now, if you want to mark them really accurately, zoom in and you want to mark the close of the first candle to the open of the next, which looks like that. Okay, that's how you mark it properly. This example is a bullish fair value gap because the price jumped from 3288 up to 3304. So between that point, at any time the market tags into that area, that's our signal to buy the market in simple terms. So if you just drop down a time frame or so, 5 minutes, 15 minutes, something like that, you can actually get the test of the fair value gap. So did you notice when the price opened here, initially the price moved away from the fair value gap as the market opened, come back and tested it here. So in really simple terms, what you can do is you can look to go long at the open of that fair value gap with a stop loss either at the close or maybe just below a low, whatever suits you. Remember, if you're going to use a low, you're going to widen your stop loss, but you're probably going to have less chance of getting stopped out. When we scroll that across, you can see that initial reaction from the fair value gap, a beautiful 3.5 to 1 risk reward trade. It's up to you in terms of your risk reward. Just use what you normally do. If you're unsure and you want me to tell you, I would say that what I tend to do is I wait for the price to hit 1-to-1 from the fair value gap. So like here, once that happens, I close half of my trade off. So I book half of my profits. When we then get to 2-to-1, if we get to 2-to-1, I then move my stop loss to entry, maybe close a little bit more off, and then I let the rest go to maybe a key high. So maybe I would have let the rest go up to this high. Then you can see what happened. I've taken some profit off the table, market moves, and then eventually, a couple of days later, price comes down and stops us out at entry. When that happens, good day's work, had some profit from this trade, delete your fair value gap and ignore it really, because it's already had the reaction from it now, so we don't need to focus on it. Another example here, this is a bearish example. You can see the price moved from there to there, as you can see, and there's our fair value gap. So price closed up here and then opened down here. So that's our bearish fair value gap. You can see what happens here. Price basically tests the fair value gap, fills all of it, actually wicks above this high. Probably would have been a stop loss trade if you traded this just in the simple way, but then price did eventually start to sink. So I've got a way in which you can trade it slightly differently to avoid getting stopped out in the simple way to trade it. You're never going to avoid losses. Doesn't work all the time. However, it does work quite a lot of the time. I've noticed really good support and resistance areas. What you can actually do is drop down even further and wait for a lower time frame reaction within the fair value gap. What I mean by that is, as you can see, when price broke below it, we can see that we actually started to form some bullish price action. So really, it was never a sensible sell. But by using the lower time frames, you can actually zoom in on the price action more and you can wait for that reaction first. So when does the selling pressure start to come inside this bearish fair value gap? It starts to occur here, and we start to see the trend shift to bearish quite quickly as well. What we can do is we can utilize order blocks within the fair value gap. For example, we may have been waiting for a move back up to here because you can see there was one of our order blocks. We didn't quite get it like this. That would have been maybe one of our sells. Didn't quite happen. Market retraced, went even lower. But if we just remained patient, keep tagging those supply zones, there comes the entry. And as you can see, even if we put our stop loss above this high, this trade goes on to make 5.8 to 1 risk reward. So there's two ways in which you can trade it. You can trade it really simply, and it does work. You can wait for like the 1 hour or the 4 hour gap, go down to the 15-minute time frame so you can zoom in on the price for where it reacts, and just enter at the open of the fair value gap with a stop loss at the close, or just below a low or just above a high. Or you can go down onto the 5-minute or the 1-minute time frame, wait for price to hit the gap, and then wait for the reaction first. That's your confirmation. Look for the retest and then go into the trade. There's pros and cons of doing it either way. I would suggest using a mixture of both. So I would always try and enter originally off the fair value gap. If I get stopped out, like in this example, it doesn't mean the story's over. You can see that it's really almost like a liquidity sweep above it. We do get a reaction at some point, as long as it doesn't go too far away from it. Once we get that reaction, we can then start to cash in, and we know that we're in our area of interest. Okay, so if you use fair value gaps trading gold, you're going to get quite a lot of opportunities because of the nature of how volatile gold is. And I hope this video has really explained the way in which you can use fair value gaps for trading gold and helps you with potentially a good gold trading strategy. If you did enjoy this video, feel free to give it a thumbs up and a like, and you can drop any questions in the comment section and I'll be more than happy to answer them for you. I'm also using these concepts every single day in our Discord channel. It's free to join. The link is in the description. And if you are looking to get funded today, feel free to check out atmosfunded.com or check the description below, and you can start a 100K challenge account for the lowest price in the industry. And I'll see you next time.